In 1975, Jeffrey Edmondson, a drug dealer based in Minneapolis, filed his taxes. As a self-employed man in the illicit drug trade, he had a good year. He sold 1.1 million amphetamine pills, 5 ounces of cocaine, and 100 pounds of marijuana. And like any other God-fearing, tax-paying American business owner, he wanted to deduct standard business expenses. On his tax return, Edmondson recorded $105,300 in costs related to selling speed, weed, and coke during the taxable year of 1974. He also itemized 2/3 of the 29,000 miles he put on his car that year, $250 for a flight to San Diego, and $200 for food and entertainment expenses during a business trip. There was also $50 for a scale, $200 for packaging supplies, and $180 in long-distance phone calls. Since Edmondson ran his business from his apartment, he deducted 2/3 of his rent. The Internal Revenue Service denied all his deductions in an audit, but in 1981 Edmondson fought the decision in U.S. tax court and a judge sided with him. He recouped most of his expenses. However, in 1982 Congress took aim at drug dealers like Edmondson and enacted 280E, a tax code that prevents businesses that traffic Schedule I or Schedule II controlled substances, which includes heroin, LSD, cannabis, cocaine, amphetamines and other drugs, from claiming standard business deductions. Today, even though 17 states have legalized adult-use cannabis and 32 other states permit medical marijuana use in some form, cannabis retailers must pay taxes under 280E. This tax code essentially makes cannabis companies pay taxes on gross revenue, a huge financial burden that makes it difficult to turn a profit. The effective tax rate, says Henry Wykowski, a veteran cannabis tax lawyer who has litigated over a dozen 280E cases, could be anywhere between 60% and 100% of profits, depending on how a company is set up. Vivien Azer, an analyst who covers cannabis at Cowen, describes 280E as an onerous and punitive tax code. It means in some instances that they are paying as much in income taxes as they're generating in pre-tax income, Azer says. The reason cannabis companies must pay under 280E is simple: marijuana is still a Schedule I drug under federal law. What's interesting is that in 2013, the Justice Department, via the Cole Memo, advised federal prosecutors to stop spending resources to pursue cases on state legal marijuana businesses. However, in recent years it appears that the IRS has upped its 280E-related audits to generate more tax revenue. It's an interesting paradigm. The federal government is spending fewer resources on state-lawful companies but reaping greater rewards under 280E than they ever have, says Garrett Graff, a lawyer and managing partner at cannabis-focused Hoban Law Group. Earlier this month, Marijuana Business Daily obtained hundreds of pages of documents from the IRS outlining how the agency has refined its training and methods to crack down on the industry.